Hello friends, in the previous video I had asked you that if a shopkeeper sells a laptop worth 10,000 to a customer for 15,000, then what will be the effect of this transaction on GDP? So let's try to understand it. If this laptop is produced in this financial year, then its value will be added to GDP as 10,000. And because the shopkeeper is providing service to you, he has a shop for which he pays rent, AC is installed in the shop, he pays its bill. So considering all these things, the shopkeeper has added 5,000 rupees to the price of the laptop. So this will also be considered in the calculation of GDP. For simplicity of calculation, if we assume that only one laptop is produced in India in a financial year and that laptop is sold by a shop for which the value of services is 5,000, then the GDP of our country will be 15,000 rupees. But did you notice that we have not talked about tax anywhere in this example? We didn't even consider the tax, which is impractical. So let's add tax here. Let's assume that 20% tax is levied on every transaction. So when the shopkeeper bought this laptop, he would have to pay 2,000 tax according to the 20% tax. This means that the shopkeeper bought this laptop for 12,000. On top of that, he added services of rupees 5,000. And 20% of this service charge is 1,000. And because you know that customers have to pay all the indirect taxes from manufacturer to shopkeeper, so it means that the total cost of laptop for the customer will not be 15,000 but will be 18,000. So now if I ask you that if one laptop is produced and one service is produced in our country in one financial year, then in this case GDP will be 15,000 or 18,000. You will be able to answer this only when you know about the concept of factor cost and market price. Basically, GDP can also be extracted in factor cost and also on market price. So let's first understand what is factor cost. See, if you have to produce any kind of goods or services, so in this case, as an entrepreneur, you will need few things, such as land on which you will set up the factory, some laborers or workers. Apart from this, you will need a lot of capital through which you will be able to buy raw materials, set up machines, make your own budget for marketing, and also bear the cost of transportation. But because everyone does not have that much capital, that is why you can take this money from the bank on interest. So as an entrepreneur, when you make a product, you also think about its profit. You have to pay rent for the land you have taken. You have to pay wages and salaries to laborers and workers. Apart from this, you also have to pay the interest of the money you have raised from the bank. And all these things have a cost. Let's assume that the rent you pay for the land in a month is 20,000. The wages and salaries paid to laborers and workers is total 20,000. And for the money you have raised from the bank, the interest you pay to the bank every month is 20,000 rupees. And apart from this, you believe that you have to make a profit of 40,000 rupees every month. So the cost you are getting to run the factory for a month is 1 lakh rupees. And let's assume that you make 10 laptops in this 1 month. So it means that the cost of making one laptop for you is 10,000 rupees. And this is called factor cost because after considering all the factors of production, you have taken out this cost. So the factor cost of the laptop is 10,000 rupees. Similarly, the factor cost of the shopkeeper can also be calculated. His shop rent, AC or electricity bill, maintenance of machines, and salaries of the workers working there. By combining all these things, the factor cost that is made is 5,000 rupees. So it means that in our example, GDP at factor cost is 15,000 rupees. And now if we talk about market price, then market price is factor cost plus indirect taxes minus subsidies. This means that if we add all the taxes imposed by the government above 15,000 rupees and if the government has given any subsidy to make a laptop, we reduce it, then the value we will get will be GDP at market price. So let's look at an example related to GDP at factor cost and GDP at market price. Here we will see a data of 3 years. According to our example, GDP at factor cost is 15,000 rupees. Let's assume that only one laptop was produced in year 2021 and only one service was produced. Then factor cost will still be 15,000 rupees, and same situation will remain in next year, that is in 2022 also. Here also the factor cost will remain 15,000 rupees because only one laptop was made and it was sold by the shopkeeper. Now let's talk about GDP at market price. So in our example, this value was 18,000 rupees. But let's assume that in 2021, the government increased indirect taxes. Its impact was that GDP at market price increased from 18,000 to 20,000. After this, let's say in the year 2022 also, the government increased the indirect taxes even more. So because of this, the GDP at market price in 2022 became 25,000 rupees. So you are seeing that there was no increase in the production of goods and services in the economy. Goods and services remained the same for all the 3 years, but still the GDP at market price is increasing continuously, and that is because taxes were increased. So now after understanding this, if I ask you that GDP at factor cost and GDP at market price, which of these indicators is a better indicator to know whether the production of goods and services is increasing in our economy or not? So the answer would be GDP at factor cost. And in our country also, GDP used to be calculated at factor cost only. But in the year 2015, India's GDP was started to be calculated at market price. I want you to write in the comment box and tell what would be the reason due to which this was done. These types of questions will help you to develop your analytical thinking and prepare you for mains. And in addition, I'll answer this question in the next video. Keep following the Indian Economy playlist. Thank you so much for watching and supporting Bookstawa.